It's time for Physician Family Finances, the show where physician moms and dads like you can get the answers and encouragement you need to turn a good earned income into great life outcomes for tomorrow and today.
Hello, physician moms and dads. I'm Nate Reineke, certified financial planner and primary advisor.
And I'm Ben Utley, the service team leader and a certified financial planner here at Physician Family Financial Advisors. Today we have a special guest. His name is Robert Hedges. Robert and I have been friends going back for at least a decade. It seems like about 20 years. Robert is one of my go-to guys when I have a question about mortgages or I have a situation that I want to get resolved. He's good at regular mortgage stuff and also unique situations. So he also has a unique backstory that makes him particularly relevant to our physician audience. So I asked him on as a guest. So Robert, introduce yourself and tell us who you are, maybe a tiny snippet about your family, and then let's talk a little bit about kind of your backstory, particularly vis-a-vis your dad, and a little bit about how you got here.
Thank you, Ben. It's my pleasure to join you today, and I look forward to hopefully sharing some information that will be helpful to your listeners about what the mortgage process is, and let you know that we're here to help with any questions they may have.
Cool.
Specifically, my family background is a medical background. My father was a physician and an internist, and my grandfather was also a physician and an internist. My mom was a registered nurse. So our table conversation invariably revolved around medical conversations on a daily basis. Whether we wanted to have them or not, we had them. But I ended up with great reverence for physicians and their families. I know how hard they work, how large their sacrifices are. At one time, I actually considered medicine as my career option. But at the time I was exploring medicine, DRGs were just coming into the medical environment, and that seemed like it wasn't a good path for me. So I looked for what I would consider to be the next biggest event compared to your well-being and health, and that to me was housing. And so that's what led me into the mortgage business some 30 plus years ago, and it's been a fabulous career, and I've loved serving and supporting physicians and others with their mortgage financing goals.
Right. Good answer. Okay.
Yeah.
Nate, I'll hand it over to you now.
Yeah. So, Robert, we have a bunch of questions, and we wrote these questions, but the way we came up with these questions was essentially these are the questions we get every day. And just like on our other episodes, we're taking them straight from the physician's mouth. Okay. So, but before we get into those, I'm curious, what do most physicians get wrong about mortgages?
Well, on average, physicians are very competent and intelligent people.
Mm-hmm.
So if I had to say a couple of things that I feel that perhaps they should rethink as they enter the mortgage process is it's not always about rate and fee and chasing the lowest possible combination. And the other part is learning to perhaps delegate to a professional because they're highly intelligent. They often will overanalyze a situation rather than rely on the support that they have in the mortgage professional that's supporting them.
Mm-hmm.
So, I see what you said about rate and fee, what it costs to get the loan and what it costs to keep the loan. If I'm a physician and I'm choosing to just look at the rate and the fee, and I see mortgages more like a commodity, right? Like Robert's mortgages and bank rates mortgages, whoever's mortgages, if I'm seeing those as all the same, what is the difference? Like, where am I going to go wrong with that? What's going to, like, if there's bad stuff that happens with my mortgage, what's the bad stuff when bad stuff happens?
Well, mortgages are offered in a lot of different arenas, Ben. You can get them from direct big box banks. You can get them from independent mortgage brokers. You can get them from credit unions. You can get them from my company, CMG, which is a very large independent mortgage bank. But I think the most important thing in analyzing and staying away from a mortgage being a commodity is helping people solve problems with related to their mortgage endeavors. And by that, my example would be if someone were to present, say, a $600,000 loan at a 6.5% interest rate with a loan fee, as compared to a 6.75% rate without a loan fee, and you looked at a time horizon of 5 years, many people would want to have the lower interest rate and choose the one with the standard origination or 1% loan fee. But the reality would be is if in fact they were going to be there for only 5 years and not accelerate on the prepayment of the loan, they would probably be better served in taking the higher interest rate and saving the upfront $6,000 loan fee. That very often is not what is offered to not only physicians, but any consumer that's entertaining a mortgage. They're not offered those choices and an opportunity to analyze that information. So that's why I would lean towards, whether it be myself with CMG or another skilled professional, actively listening as you talk to and look at your options to someone that you think will serve you in that capacity.
So if I'm hearing you correctly, um, it's the rate matters, but it doesn't matter if you're not going to have the loan for very long. I mean, conceivably, you could have an 8% loan that you're going to keep for a month, in which case you don't really care what the rate is. In that case, the expense of getting the loan is more important. But if you're going to get a 30-year loan, you're going to take 30 years to pay it off, which we almost never see with physicians, then the rate is really the thing to focus on, in which case maybe you should buy down the rate, right? In which case the fee could be a little bit higher. Is that basically what you're saying?
You could do either or, Ben, depending on your time horizon in that home.
Mm-hmm. And Nate, how often do you see physicians hold their mortgages to maturity?
Never.
Yeah, same. In fact, one of the things that I see is physicians will take a 30-year note, which has a higher rate than they would with a 15-year note. You and I know that they're going to pay that loan off in 15 years or less. And yet they'll take the 30-year loan for flexibility, and then they pay the 30 like a 15-year. I've seen that over and over and over again. Robert, have you seen that?
Yeah, and it's not a bad strategy. It allows flexibility and would allow them to navigate whatever plan you may be establishing for their long-term financial goals.
Mm-hmm. Yeah, I oftentimes see it where they'll just, in the beginning, when they're trying to get a house, a lot of times it's trying to get settled into a house, settled into a new life. Maybe you changed jobs, had another child or something. And so they need that flexibility up front, and then they get bonuses or something happens throughout their life. Maybe it's not every month, so the monthly payment matters, but probably every year, some lump sum of money comes in, and you just can decide whether or not to pay down your mortgage a little bit early. Robert, I'm curious about so you said a couple things that our listeners can't see me unless you're on YouTube, but I was violently agreeing, shaking my head up and down, which is I noticed that when I look at mortgage brokers that are communicating with our clients, if I have a client that's asking for a rate, they said I want a 30-year rate, they need a quote. They pretty much will just send them back a 30-year rate. That's all they get. They don't get this conversation that you're talking about where you discuss options and you go pros and cons. How does somebody find, other than you, obviously they can call you, how does somebody find a good mortgage broker that's willing to discuss this with them and willing to explain things like whether or not an ARM is a good idea, an adjustable rate mortgage? Like it's difficult to find those people. I'm curious how you might recommend someone look for them.
Yeah, I think a lot of it comes through active referrals from family, friends, real estate professionals. financial advisors.
Mm-hmm.
It unfortunately, in the mortgage industry, there is no formal blueprinted path to becoming a mortgage professional. There is no undergraduate degree that would specifically target the mortgage industry. Many people that come in either come in through the real estate side and or they've provided support for a mortgage team and then evolved into a loan officer, or they go the bank or credit union route where that's kind of an internal elevation from
Mm-hmm.
personal banker to installment loan representative to either residential mortgage professional or commercial loan officer. And that's kind of the path over time. It really is about the referral base that you have, the professionals that would guide you, and then actively listening when you begin to have conversations either online or on the phone about, is this a person that I think it has my best interest at heart,
Mm-hmm.
and would I be served to work with them because they're going to try and offer me options and solutions to what I'm presenting to them.
Yeah.
I want to play devil's advocate here for just a second. So, you mentioned getting referrals from like accountants, CPAs, maybe attorneys, financial advisors. I think we are in a position to be able to judge the kind of the goodness of a mortgage broker, their fitness for the job. Maybe having seen their work, we know whether they're on the take or whether their rates are reasonable. I personally know someone in the mortgage space who is well liked, does a lot of business in their sphere of influence with friends and people that are familiar to them. I had a conversation with them where they were telling me about how they run their mortgage practice, and I just found the fees to be egregious. I mean, anyone in their right mind who's really looking at the bottom line or paying attention to the details would look at that and go, "Man, you're absolutely being taken here." So if I'm a physician and I'm not super well versed in this world, which is even to a financial advisor relatively difficult to understand because the way the fees and the rates all go in together with points. What is like one thing that I can look for as a physician that's going to give me some heads up that maybe I'm in the wrong place?
Well, I would say if the rate and fee looks like it's too good to be true, it probably is, right? I mean,
Uh-huh.
80 to 90% of mortgages in our national mortgage arena in some way get delivered to Fannie Mae, Freddie Mac, Ginnie Mae, in other words, our government.
Uh-huh.
And so when I'm competing against others and asked to do comparisons, very often if something is coming, like for example, I saw a quote the other day from North Carolina. It was a mortgage broker that is licensed in Oregon to do business. The rate and fee combination was so far below the national average
Mhm.
that you knew right out of the gate that it was not going to be a very good fit. And the best mortgage in the end, Ben, that closes is the best rate and fee, right? The one that successfully achieves the goal of getting someone into the home.
Yeah.
I wish I had a template to tell you how to compare things. I would just say you want to, when you're asking for information, ask for not just your best rate and fee, but show me some options so that I can make an informed decision.
I see.
And a lot of the price leaders, the people that would commoditize the mortgage, will lead with their best rate and hold back the fee for later, right? That egregious fee that you were speaking of, right?
A little bait and switch. Yeah.
Exactly. So
Yeah.
I always like to give people an option. Here's one option. Here's a little lower rate, and the fee. Here's a little slightly higher rate, because the investor is not. They're really concerned about the return on the investment, right? So this doesn't matter if it's a rate without a loan fee at all, or even a lender credit,
Mm-hmm.
as opposed to a lower rate with fee. Part of that fee may be going directly to the investor, Fannie Mae or Freddie Mac, or a pension fund or insurance company,
Mm-hmm.
in order to drive their return right out of the gate.
Well, there's something else. I mean, I want to move off the fee conversation here pretty quick because it's certainly not all about fees. But when I've looked at mortgage quotes and things that I've seen from you and other folks, it is not uncommon for a physician to say this fee is really high. And then when I look at the good faith estimate and I see what the physician is considering to be a air quotes fee, it's things like escrows and impounds, and there are things in there that are don't even look anything like a commission. In fact, there are things that a person would pay whether or not they were refinancing a mortgage. So, in layman's terms, don't use our familiar mortgage financial advisor speak. Talk to me in layman's terms about what a person might confuse as a fee and what constitutes an actual, I would say, like sales charge on getting a loan.
Right. It's a really good point, Ben. There are really three buckets of fees associated with any transaction. There are the lending related fees, there are the title and escrow related fees, and then there are the escrow impounds, if any, which is really the repetitive costs that you're speaking of, the setup of taxes and insurance within the payment if they choose to have that. Those are all reoccurring fees. The other fees, the escrow and title fees, they're going to be, regardless of where you are in the country, you're going to have them, right? Whether it be closing with an attorney in the East, or if you're using a title company for title and escrow services in the West, and then the lender related fees, right? Which would be an administrative charge, a loan fee or not, an appraisal fee or not.
So what I'm hearing is title and escrow is independent of the mortgage. That's something that you would pay if you were buying a home with cash. Is that correct?
Correct.
Okay. So that's not dependent on the mortgage. The other thing that I heard was taxes and insurance. And so we use the word impounds, and I'm going to break that down for our listener. So these are things that you pay up front. So for example, you might pay several months or even a year's worth of property taxes up front, and there's going to be homeowners insurance because the company lending the money to you wants to make sure that the property is not taken away by the government and doesn't go away in a fire. So they're going to ask you to pay those things up front. These are things that you would pay whether or not you had a mortgage, whether or not you were financing. Like these are things you pay when you own the home. And those two things, title and escrow fees, as well as taxes and insurance impounds, I see very commonly confused for the actual cost of originating a mortgage. And it leads people to make improper decisions.
I think it's an astute point, Ben, especially if the financing is 80% or less of the purchase price, where you have in most states an election as to whether or not you want to put taxes and insurance in your payment,
Hmm.
right? So it's
Right.
someone doing 25% down, an estimate that was presented by someone that excludes taxes and insurance because they're not choosing to impound taxes and insurance
Hmm.
may look at, much more attractive than someone that has a standard impound in place.
Yeah, when I think about this, if I'm a physician and listening to financial advisors talk about mortgages, I, in some sense, I imagine it must be like financial advisors talking about antibiotics to each other. Like
Mhm.
what do we know? This pill's bigger than the other one, so it must be better, right? I mean, it's that basic because any physician worth their salt would know the difference. But from the outset, it looks like a pill. We think it's an antibiotic. We think we know how it works, but it's not really that simple, right? And sometimes you don't know if what's in the bottle is the thing that they even intended to fill. So, uh, yeah, I wanted to clear that up because that's something that we do see on a pretty regular basis. People misunderstanding it, especially if they're literally just holding up two numbers and comparing like this one's bigger than that one, right?
Okay. I got some questions for you, Robert. This one is sort of a time sensitive, but I want to know if you can tell us about what's going on with ARMs right now and 15, 30-year fixed rates.
And what's an arm?
And what's an ARM?
Yeah.
So let's start with let's start with fixed rates. So 30-year fixed rate is probably the most widely accepted mortgage, whether it be a conforming loan in our area under $806,500 or larger, which would be a non-conforming or jumbo mortgage. And a lot of physicians will actually be entertaining those types of mortgages. So the two most readily accepted mortgages in the industry are 30 and 15-year fixed rates. 15-year fixed rates are typically somewhere between 3/8 to 5/8% lower. They get a lower interest rate than a 30-year because of the accelerated repayment term. Adjustables are interesting. Historically, they've served the markets nicely because they have, most of them are all 30-year terms, Nate, with varying periods of initial fixed rates. So you might have a 30-year amortization on a variable that's fixed for 5 years or 7 years or 10 years, and then it gravitates to the variable features. Today, they're not readily used. And the reason is because the market has been anticipating for quite some time a rotation lower in mortgage interest rates. And so even if you're a local credit union, the prospect of having a 5-year adjustable refinance early within that 5-year period is high enough that they don't want to take that risk on. And so if I were to look at a rate grid today and show you ARMs 30-year and 15-year, you would see the 5/8% lower 30-year to 15-year in terms of rate improvement, but you would see no elevation or improvement for taking a loan that's only protected for 5 years or 7 years. When I've recommended those in the past is when people were able to share with me that, gosh, Robert, I'm only going to be in this house 5 years. I know that because my last child is graduating from college in 3 years and will move to a smaller home in a couple of years thereafter. I would really want to see them benefit, right? If you're going to take a 5-year fixed rate, I would like to see, at least 5/8 to 3/4% lower rate and perhaps no loan fee associated with that rate, because I know that I'm going to face the reality in 5 years. I'll have that mortgage in 5 years and I'll be subject to the parameters of the adjustable, or I'll be rotating into a new mortgage.
Mm-hmm.
Okay, so break it down for me a little further. So what I'm hearing is that ARMs, adjustable rate mortgages, you're not recommending those right now because the rate is very close to like a 15-year fix. Is that correct so far?
It's even higher than that, Ben. There would be no improvement with an ARM over a 30-year fixed rate at this time. And in fact, the appetite is so lacking for ARMs in the overall mortgage market that you can actually see an ARM rate equivalent to a 30-year fix, but significant higher loan fee.
I see. So if I'm the lender, I'm pricing my ARMs prohibitively expensive because I'm expecting that interest rates might go down and people would refinance those ARMs, and I wouldn't recoup my costs of delivering that into the market. Is that correct?
That is correct.
Okay.
Wow.
And so in practically speaking, if I'm that physician and I'm thinking I'm going to be out of here in 5 years, ordinarily a 5-year ARM would be the right thing to do. But what I'm hearing is that, the rates on those are actually worse in some cases, and that now I'm still bearing the risk that interest rates could shoot up in my 6th year, and then I'm stuck with this thing, right? So it's just not only you not recommending these, we're not seeing them, and it's like everybody's anticipating rates to go down in the markets, and so that's why these are just not available.
Yeah.
And I've talked on the show before about having purchased my the home that I intend to retire in, though not my retirement home. And you and I went through this on my note. I called you up. I had had my order. I wanted to fill my order. Hey, Robert, I want a 3 or 5 year arm. And you're like, hold on a minute. That's not such a great idea here. And I wound up taking a longer note.
Right.
Yeah.
That's right.
Yeah.
And we stayed away from upfront loan fees. And
Yeah.
it remains that I think that was the best informed decision.
Yeah. Yeah.
I want to
Good.
highlight something that you both are saying, but I don't know if it's totally obvious to our listeners. So an arm is an adjustable rate mortgage, and the people that I speak with every day, they when they hear that, they get very nervous. They don't like the idea of an adjustable rate mortgage. And what I think, my hypothesis about this is that during the 2008 mortgage crash, adjustable rate mortgages were abused, and therefore everyone thinks that is this nasty product. But I actually think that the abuse was the problem, not the actual product. And that what you're saying, Robert, is that if you know you're going to move from a house in 5 to 10 years for a variety of reasons, physicians move all the time. And Ben and I looked this up once. I think the average person stays in a house for 7 years. So in a different market, someone could most likely get a 7 or 10 year arm, save a little bit. If right now that's not the case, but usually that it is, and use this as a tool rather than some yucky product. Is that what I'm hearing you say?
Absolutely. Absolutely, Nate. Yeah, it could be a great product. It's just right now there is no significant market. Now there will be occasions where you will see a regional bank or a credit union that has a specific amount of funds that they want to hold a loan in portfolio, and it may be that they offer something that can be attractive. Mm-hmm. But when I recommend adjustable rate mortgages, I like to see a pretty significant improvement over a standard 30-year fixed rate mortgage, either in interest rate and or loan fee, before I would have someone gravitate to that bucket of financing option.
Okay. I have another question that I wanted to circle back to, and this is on my mind all the time. I want to know, when is the right time to buy points?
Yes, I want to know too.
Well,
and first, what are they?
Yeah, what are they? What the heck are they?
I'm going to be the educator and questioner in chief here on stuff that's like, I appreciate the industry jargon, but I want to make sure that I break it down. Like, what is the point of a point? What is the point?
Yeah. Well, point is 1% of the targeted loan amount. So it's a prepaid finance charge that presumably goes towards lowering the interest rate over the life of the loan. So, for example, let's say we had a 6.25% interest rate and a 1% loan fee, or a 6.5% rate and no percent loan fee, no points, either origination or discount. You see those terms thrown around a lot. Well, we don't charge an origination fee or no upfront points. But then on the other side of that, you'll hear the term discount fee, and discount fee really is equivalent to loan fee, right? So when you're shopping for that mortgage, you want to look for, okay, what are there any points associated with the loan, origination and or discount? You'll see those, both of those terms presented.
Are they the same? Are origination and discount the same?
To me, they are, Ben, because they're an upfront cost to achieve presumably a lower interest rate.
Okay.
I like points when we have a buyer's market and a seller's willing to participate in the buy down of the rate, and you can get them to do that. I also like and we'll look at with borrowers upfront origination fees if I can recapture those upfront costs within a very short period of time. For example, if I could achieve an interest rate of 6.375% and it only cost me 1/4% loan fee, I might recommend that because when we look at, how quickly you get ahead with that loan based on the lower payment, it makes sense to me. And to me, I like to see that recapture period be within 12 to 18 months.
So to paraphrase here, you're talking about when you say recapture period, you're basically saying break even, which is to say if I
Right.
got to pay a little more up front to get a little bit lower rate, how long is it going to be before that breaks even with not paying some upfront and paying a little bit higher interest over time? It's your
That's,
break even period, right?
that's right.
And I also heard you use the word discount, and
Yeah.
I think if I'm just a standard physician, I hear the word discount and I think, oh goody, I'm going to pay less. But what you meant when you said origination and discount fees, it's not an actual discount. It is a fee you pay to get a discounted rate.
Correct.
And so if I'm getting the broad takeaway here, it's really when it's what you pay to what you pay for the mortgage and what you pay on the mortgage, the lenders kind of don't really care about that. They want to put together the combination that works for them and for the borrower. And it could be that you pay more upfront or you pay more later. It's like pay me now or pay me later, but you're going to pay me. And it's just a matter of the planning around the mortgage for like how long you're going to hold it and what your intentions are for the home that really makes a difference between this balancing act of what you pay up front and what you pay later on.
That's correct.
Okay, I have another question about points.
But wait, we didn't answer the question. When do you pay points?
Oh yeah, when should you? Well, he said payback period of 12 to 18 months.
Okay, got it.
You got to do some math.
And also, if we have a seller that's willing to participate in your upfront loan fee, right? That's the best
That's
of
right.
all worlds.
Yeah.
Yeah.
So I have been seeing quotes from mortgage brokers across the country. And sometimes these quotes come back and it's required that you pay points. Is that just a fee, or is there some program that makes them get the rate down to a certain amount? Like, tell me why a mortgage broker would require paying points.
Well, it may be the way their organization is set up in terms of they're just not in a position to offer a slightly higher interest rate and avoid the loan fee entirely. So mortgage brokers essentially arrange the mortgage in the marketplace for you. They submit it to a wholesaler that then delivers it into the secondary mortgage market, right? So there may be some limitations there. In the last couple of years, post the really low interest rate environment that we had during COVID, a lot of the investors are requiring some upfront fee because of the concern about rates rolling over, the economy rolling over, rates going down, and the rush to prepayment. So the servicers of the mortgages are saying they really need to see some level of return right out of the gate.
That's interesting. I'd never heard that before.
Nate, as I'm hearing this conversation, I'm wondering how things would look in another country where we don't have this kind of put option on mortgages, where we don't have a fixed rate mortgage. Because I know that overseas, variable rate mortgages are like pretty much all that's there. And I'm just hedging because I would say everywhere outside the United States. It seems to be a unique thing that we have here.
It's an unparalleled system. If you were to go to Europe or Canada or other environments, you'll see they may do a 30-year, 25-year mortgage, but they might only fix the rate for 3 years, Ben, and then it's a reset to where the market is. They also require a significantly higher down payment in most cases.
Okay. All right. I want to know about construction loans. So they're complicated. I know this. I'm curious, just a high level view of what they are, but also how many people need to be involved to actually successfully get a construction loan to help someone build a house.
It's a great question, Nate. I would suggest that there are 3 types of construction related loans.
Okay.
The first and simplest is the builder builds it and you buy it. And so we're looking at potentially protecting a rate environment for the borrower for the duration of the build. So you don't have to protect it, but in many instances, you will want to protect it with the ability to have that interest rate renegotiated as the project is completed. So that's the simplest form. Builder builds it, buyer buys it, right? That's one option. Another option is a loan that's called an all-in-one loan. That's a loan that serves as to help you with the construction of your home, but at completion, it rolls to permanent financing. So that's why it's called an all-in-one loan. And that loan closes as if the new house is already there, right? So we underwrite it, appraise it, close the loan, set the residual funds in an account to be drawn out monthly until the house is completed, and then it goes directly to your permanent financing. And then the third option is what we call a two-step mortgage, where there actually is a construction loan followed by permanent financing at the completion of the new home.
Mm-hmm. So in the third scenario, you would buy a piece of land, I assume, first. So there might be two loans that you're floating, and then you combine it all at the end?
No, there's just one loan.
Okay.
In all cases, there's one loan, because we're always going to appraise the house as if it's there, right? And so in some instances, you might have a client that doesn't have a strong enough down payment to pay for the land all at once, right? So when we close either the all-in-one loan or the construction loan, we're going to pay off residually what's the difference between the property cost, the bare land, and what they're able to put down.
Mm-hmm. Okay. This is a question that does come from construction loan situations, but also with real estate agents. So a lot of times what I'll see is the builder or the real estate agent has a preferred lender. And my interpretation of this is just purely, I haven't heard anyone actually say this, but what I take from their preferred lenders is not really that they are the best fit for the person getting the loan. They maybe don't offer the best rates or fees. They simply can fund the builder or the real estate agent has confidence in that lender that they will get the loan through. Therefore, that person will get their money. So did that make sense? And do you see that?
So kind of the question is almost like, why do real estate agents favor a particular mortgage broker? Is that kind of the nature of your question, Nate, or did I
That
get
is
it
the
wrong?
nature of the question. So why do they favor someone? And it is oftentimes pitched to them that this is the only person that can do the job, meaning that can get them the loan successfully, or they're the best for whatever reason. So I'm wondering, how does someone go out and choose someone else other than the preferred lender and have confidence the loan will be funded and they will do a good job?
Well, it's relationship business, like you'd indicated, Nate, where the realtors had a positive experience and may know the mortgage professional personally, and it is, they are as interested in anybody in making certain that the transaction is successful and
Mm-hmm.
results in the physician or buyer owning that home. But my experience with realtors and or builders is, if the borrower says, I'd really like to have an informed conversation with at least one or two other professionals so that I can do some comparison and get some coaching from my financial advisor, you'll quickly see that in most cases they'll back away from it. I don't think it's in stone. I really don't.
For construction loans, do you think it is beneficial to go with a mortgage company that specializes in construction loans, or can most mortgage brokers do this pretty well?
It's a specialty product, Nate, and you want to vet out a lender that does a lot of construction lending.
Okay.
There are more steps involved in a construction loan by far. As a matter of fact, just in our area, I know of 3 regional banks that used to do thoughtful construction lending that have virtually removed themselves from the marketplace. They're no longer doing it because of the risk. You're closing a loan as if the house is already there, and
Mm-hmm.
there's no way to deliver that loan to the secondary market until the house is complete. So, in many instances, it's even tighter than it was way back when we had the financial crisis. Right,
Mm-hmm.
just outside of that time frame, there are just fewer people wanting to participate in that market. But it comes and goes. You'll see for a while somebody's not doing it. I know of a national bank right now that just has electively chosen not to do home equity loans. They just not consistent with what their goals are.
Mm.
But you'll see them come back as demand comes up for them.
So, speaking of big national banks, one of the questions I have is about the choice of the venue where a physician gets a loan. And I'm not talking about a physician loan or doctor loan. I'm talking about just a standard, maybe a refinance. Somebody's got 25 or 30 or 40% equity in a home. Like, let's say maybe $1 million home. They've got 400,000 in equity in it. So they need a $600,000 mortgage. And they're looking at a choice between going to, I wouldn't even say they're looking at a choice. Sometimes I just see them go straight to the bank. They'll go to a big box national bank because that's where they're doing their banking relationship. Or maybe they have a business, like it's a self-employed physician, and their business is bankrolled through a community bank. And other times, maybe they have a friend who's a mortgage broker or real estate agent who sent them to a mortgage broker, or they come to us. And Robert, you're unique in that you have experience in multiple environments, having been a lender or a loan officer in those environments through, gosh, a wide variety of interest rates, economic, geopolitical environments. In terms of today, like if I'm that physician with $1 million home, a $600,000 mortgage, and I'm looking to begin my refinance journey tomorrow, what is the difference between using someone who is in your stead versus going to the big bank, or what Nate would call the big evil bank?
Well, uh, an independent mortgage bank like CMG does nothing but mortgages, right? So if we
Mhm.
don't do those very, very well, we're not going to be around very long.
Okay.
So I would say you want a specialist, someone that does mortgages. There's no reason not to entertain where you do your local banking or have relationships. However, I think it's always advisable to at least sound out 2 or 3 different sources so
Mm,
that you can make an informed decision.
okay.
Mm-hmm.
Yeah, I guess if I'm with the big bank for my checking and my savings and that kind of stuff, it's really easy for me to open a statement stuffer and see, interest rates now, blah blah blah, low down loans, that kind of stuff, and just automatically hop to them. In which case, they don't really have any competition. If I'm opening a statement stuffer, I'm calling the 800 number, then I'm immediately a fish on their line, as opposed to someone who's being studious about this and intentional about getting their mortgage, in which case they evaluate all the options. So I guess in that case, there's a chance that rate and fee combination could be not as advantageous as if I went and I looked in the competitive market and I basically shopped around.
Absolutely correct.
So I know that not even in mortgage brokers, let's say that this we're talking about your kind. I know that even from one mortgage broker to the next, that assuming that you even had the same access to the products, I know that there's something about the relationship with an appraiser that makes a real difference in terms of a home buying experience. Can you talk to our listeners a little bit about the relationship between lenders and appraisers and basically getting the job done, getting the home bought?
Right. Well, it's somewhat of a delicate conversation, Ben,
Hmm.
post 2007 and 8, where there were some abuses that took place between direct dialogue between appraisers and mortgage and real estate professionals in terms of what the goal was.
Hmm.
Um, and a lot of legislation actually came out of that with Dodd-Frank and other uh, uh, new regulations that require some level of autonomy and independence between the mortgage arena and the appraisal arena. What I can say is that if you're serving a particular geographical region, you have the ability to choose how and who you want to work with in terms of an appraiser. So I wouldn't necessarily be able to speak to the appraiser directly about an assignment, but we do have the ability to vet who we want to have on our panel. And so we would look at the highest quality appraisers that we can find in our area and make certain that we invite them to be on our panel so that they're in the rotation, and so that we know that if they receive an assignment, they're going to be professional, turn it in timely, and do the very best they can to fulfill what the obligations of the assignment are. If you were to go through an appraisal management company, they also do some vetting, but they're not as directly correlated as, say, an independent mortgage bank would be. They can develop their own panels as well. But, I would say that, local whenever possible is better, right? The challenge is when you have an appraiser from 50 to 75 miles away comes into your market and assumes that they're knowledgeable about your market. And it's really much more about having local knowledge and experience in that market for appraisers.
So assuming a fair and unbiased appraisal, then what I'm hearing here is that basically whether or not the appraiser really cares about the deal, whether they're attentive to details, whether they kind of are fast and efficient versus kind of slow and unreliable, it sounds to me like that could make or break a housing deal.
Absolutely.
Okay. I want to talk and kind of face our conversation toward physicians starting out. So a physician just starting out, they got out of residency, they don't have enough money to buy their first couch yet, or they're just about to get it, right? But they want to buy a house and they're convinced that it's time because they've waited long enough. What's the smallest amount of money a brand new physician can put toward their first home purchase?
So if they're buying a home that would be, and this is regionally based, Nate, but in general, a conforming loan limit today is $806,500. That means that Fannie Mae and Freddie Mac, if you originate a loan that fits their guidelines, are willing to do up to 97% loan to value, whether you're a physician or an allied health professional or not. So that would put you in the $830,000 roughly bucket, 3% down. Most physician loans, the vast majority that I've had experience with or have found in the marketplace, and they come and they go, by the way. At times, there'll be a hot product that you'll hear about and it'll be offered for a while and then it goes away, would be approximately 5% down. So those non-conforming loans that we talked about earlier, or jumbo loans, would be 5%. But with physician loans, they're very encouraging in terms of debt to income ratios and qualification. But because there's a higher risk associated with lower down payment, they are interested in the physician having some level of payment reserve at the time that they close those transactions.
Okay. So I think what I'm hearing you say is that the physician loan, the structure of physician loans change, or the programs change. So 5 years ago, I saw zero down physician loans all the time. And nowadays, maybe it's more like 3 or 5%, and that could change again as time goes on. Is that correct?
Yeah, that is correct.
Okay. Speaking of physician loans, I have another theory that isn't exactly tested, but I believe when I look at physician loans that a lot of times it is thrown around that you don't have to pay PMI, so private mortgage insurance, and that's what, for our listeners, that's what you pay if you don't have 20% down. You have to pay some form of PMI. But a lot of times I look at these physician loans and the rates are just higher. Am I getting that right? Or is that just apples and oranges and I'm comparing one bank to a different bank and they just have different rates?
No, what's happening there, Ben, Nate, is that they're self-insuring that loan, so they're going to increase that interest rate in order to bridge that normal private mortgage insurance that you would see.
Hmm.
And so that's a very astute observation of yours, because that's one way you can self-insure. In other words, you're going to absorb the risk with a higher rate.
Yeah. Okay. So once again, what you said at the beginning of this of our show is that you don't want a broker who is just going to give you the quote you asked for. If I could choose any broker or one quality of a broker, it would be they would understand that someone going in to buy their first house doesn't really exactly know what they need. They know what they've been told that they need. They know they've been told they should go get a doctor loan, but they don't even know if that is best for them. So a lot of times I think you can correct me if I'm wrong, but physicians should ask for a doctor loan program compared to just a regular conventional loan with PMI attached to it.
100% correct.
Okay, got it. Glad I could confirm that. Okay, I have one last question before we're going to do rapid fire questions after this. That should be fun. But one more question. It seems like times are changing right now. Things are a lot different than they were even just a few years ago. Some uncertainty, people hearing about stagflation. I expect rates to change pretty soon, but if a physician is looking to buy a house, say in the next 90 days, what should they be looking out for with rates and how they approach their mortgage?
Well, I would suggest that one, don't wait for rates to enact your purchase, right? If you're
Hmm.
ready to buy a home, um, it it is a form of an investment, but it provides the shelter for your family. So I wouldn't wait. Real estate has a tendency to do pretty well in recessionary periods if you look over long periods of time. So I wouldn't wait. I would stay away from upfront loan fees, because our expectation is that when rates do roll over, there will be a nice refinance opportunity. We just don't know if it's 6 months from now, 18 months from now, or 30 months from now, but it will be available. So if I had to guide someone, I would say be sensitive to how much you pay in upfront fees, because I don't believe, one, like you do, that they'll be in the house for 30 years if it's their
Hmm.
first home. And two, it's very likely that we'll revisit that note rate and that loan within a short period of time.
Okay. Okay, thanks for that. You ready for our rapid fire real estate mini round? That's what we
Wait a
call
minute. Wait a minute. Wait for it. It's time for the rapid fire real estate mini round.
it. All right.
I
I,
think I'm ready.
cool. I have four quick questions. So
All right.
you can answer them fast. What's the most surprising home buying myth?
That you need a giant down payment to buy a home.
What's your dream city to live in?
I went to UC Santa Barbara, and that was a pretty neat city to hang out in.
Yeah. Okay. That is a dream. California prices. Um, let's see. One home feature that's totally overrated.
I would say formal living room.
Ooh, love it. All right, and last question. Beach house or mountain cabin?
Toss up, but I'm going to go with mountain cabin. Beach houses are brutal on maintenance and repair.
I've seen that more than once. Okay, Robert. Thank you for your time. I want to know, can you let our listeners know how they get in touch with you?
Yeah, thank you, Nate. It's been a pleasure to be with you and Ben today. You can find me you can email me at rhedges@cmghomeloans.com. You can call me at 541-515-8026. That's my cell phone. or you can Google me at Robert Hedges at CMG Home Loans.
Cool. And we'll put that in our show notes as well if they want to get in
Oh,
touch
we
with you.
got the direct dial mobile number. When Nate, when we're talking about like, what do you want in a mortgage broker? I want the mobile phone. So
Yeah.
that way I can pester them if something's going wrong in the middle of the night. I can be like, hey, my mortgage is not going right. I want to be able to reach out to you. So
That's right.
right, Robert?
Absolutely, man.
Yeah.
100%.
Okay. Well, thanks for listening to the show, folks. I'm going to start to take us out here. So if you're looking for a mortgage broker, you could do worse than meeting with Robert. You know, he's been great. I've known him for years. I've done a few homes with him, and we've had a number of clients who have gone through Robert and said great things about him, which is how he made it onto the show. If you are looking for a financial advisor who has a depth of home buying, refinancing, second home purchase knowledge, Nate Reineke is our in-house housing and home loan guru. He regularly speaks with people like Robert on our coast, which is West Coast, as well as East Coast, South Central, all over, as long as it's the United States. He's my go-to mortgage info guy. So if you're looking for a financial advisor who has that type of knowledge in-house, as well as other things, maybe you should consider us. You can visit physicianfamily.com, tap on the Get Started button, and schedule a time to see if we're a match. Or if you're not ready for that and you'd like to ask your own question, you can email us at podcast@physicianfamily.com. And until next time, remember, you're not just making a living, you're making a life.
Are you ready to turn worries about taxes and investing into all the money you need for college and retirement? It's time to make a plan and get on track. To find out if we're a match, visit physicianfamily.com and click Get Started. Or you can ask a question of your own by emailing podcast@physicianfamily.com. See marketing disclosure at physicianfamily.com/disclosures.